Betty, how are you?
Hey, Josh. I'm good. How are you doing?
Doing well. It's like we have a few folks beginning to trickle in.
Cool.
Um, yeah, we can go ahead and get started. I'm sure a few people will come in these first few minutes. But thanks everyone for joining today's Karura community call. We have a few exciting updates for y'all. I'm Josh. I lead some of our community management and user support efforts, and we're joined by our co-founder Betty. Betty, do you want to introduce yourself?
Yeah, sure. Well, thanks for those who are still showing up. I know, in the last couple of weeks, there's a significant shock to the whole crypto world, probably beyond crypto world. Really glad to be here today. We'll actually share a little bit of insights and also maybe a bit of reflection on what happened last 2 weeks and how that actually impact us and probably how that benefits us in another aspect. And also, there's quite a number of stuff going on for Karura and Acala, and hopefully I can share a few more news as well. So, yeah.
Great. So I think you mentioned reflection over the last few weeks. I think that could be some important context setting for some of the other things we talk about in the update. So do you want to just give us your impressions of how the last few weeks have been just in the broader crypto market, and if there were any key learnings for us as a team?
Yeah, I'll actually be more specific because I'm sure everyone's, read almost everything that are available everywhere. There's so much news exposure, and that even got out of the crypto world, right? So I literally have, random friends that have no idea about crypto and ask me about Terra and USDT and everything else. So yeah, I won't go into those general sort of discussions, but probably more specifically how that relate to Karura and Acala, and specifically the lending protocol, the stablecoin protocol that we have. And first of all, well, I think we are kind of in a bear market, but more significantly, there was a cliff fall of the market in the last 2 weeks. And then that cliff fall is probably more dramatic in some ecosystem versus the other, especially the earlier ecosystem. I think Polkadot and Kusama, even though it's been around for a long time, but you can see the XCM, like almost like the Polkadot 1.0, the last piece of the Polkadot 1.0 only launched 2 weeks ago. And then for Kusama, after 10 months, like since Karura launch, we finally connected to 20 plus parachains and a dozen to come. But that didn't happen on day one. That happened over the course of 10 months. Probably nothing happened for all the parachains in the first 5 months. And then in the last 3 months, all of a sudden, from user perspective, all of a sudden, there's lots of connectivity and also crushing activity. But actually, we work through the whole process to help those parachains to work through testing, and then you see the crushing activity start happening. So on the Polkadot side, I think that same pattern will happen again, but hopefully in a much faster speed. Because we've all gone through the testing there. So you can see, Polkadot and Kusama is probably still early in terms of where the ecosystem are at. And so it was also dramatically impacted in that cliff fall of the market. And then if you're talking about magnitude, it's probably equivalent to the Black Thursday in a couple of years back. So that was an event where ETH fell off the cliff like 90% plus on that day, and then it caused MakerDAO. So like it is a stablecoin model that we are probably mostly close to. They gone into insolvency, and then liquidation wasn't happening as expected, and this liquidity crunch, and it was just a chaos, right? So, but of course, they kind of recover using different mechanisms. They had to sold. They have to print MKR, so their governance token, and then auction that off, and then to recover some of the debt, and then also that was also the point where they had to open up USDC as collateral to help with liquidity. And then after that, there's also a rise of professional liquidators like keepers, so that they can actually bid in the gas war on Ethereum, because one of the major cause of the incident was the network was congested, and then oracles and also liquidators cannot function because of the gas was really high, and no one can actually send any transactions on chain. So that was a major event back then, and also very relevant event because of we're using the same over-collateralization model. So that was the context. And then what happened 2 weeks ago when a cliff fall, so triggered by a terrorist black swan event, was DOT and KSM also felt in a similar magnitude. And on the surface, that was just how the token performed. But I don't know if anyone looked deeper into any of the lending protocols around Polkadot ecosystem, looking at Acala and Karura as well. It was actually a dramatic event for us, because we are essentially experiencing the same market condition as Black Thursday. But of course, the result wasn't as dramatic. The chain didn't halt. The on-chain liquidation process we had using off-chain worker, and also the quality of service for oracles, they all worked as expected. So that was a great thing to see. But also at the same time, it wasn't a nice event because of the clip force, because that was the time where your protocol is tested, and then you can actually see liquidity shrink quite significantly. So liquidity means how much AUSD is out there in the market, and it caused. There's two major reasons. One is obviously the collateral values. So KSM, DOT, ACAKR, LKSM also related as KSM, and LDOT related to DOT. They all the value evaporated significantly. So that's one reason. The other reason is there's liquidation events. So as the value falls or the price falls, your vote position becomes in danger, and some of them couldn't actually defend their vote, and there's liquidation events happen, and both of these actually caused the liquidity reduce dramatically, and also there's lesser liquidity than before. So I think for Acala, the AUS liquidity fell about maybe 20 and 30% compared to the event before the event and during the event. So that's quite a significant fall. But now it's bounced back. I think one of the contributors there was the LDOT collateral opened right after the event, and that probably helped a little bit to ease the liquidity shrinking. And also on Acala, there are way more collateral assets. So LC dot, L dot, and also dot itself. They're relatively sufficient liquidity. Collaterals over there to support people's votes. But still, it kind of went through that liquidity shrinking process as well. And then on the Karura side, similar thing happened. Liquidity also shrinked, and also KSM was extremely volatile in comparison to DOT. There's a huge swing there, So maybe I'll share this report. There's a dashboard. Where's our chat? Oh, there we go. So I'm sharing this link that folks can take a look. So there's a dashboard for Karura provided by Ganglet. There's one for Acala as well, but that was still in staging stage. Ganglet will be releasing them once that's ready. So there was a number of days KSM was in. If you look at the bottom of that link, it actually tells you each collateral asset, the risk or safety status. So at one point, KSM was actually high risk, and LKSM as well, due to the liquidity available as well as the volatility in the market. KR has been staying as medium all the way through. One of the reasons was there's enough liquidity in the market that can absorb any of the liquidation that happened. And then that comes down to another interesting and also quite critical factor is how we handle liquidation. I mentioned that Maker went into insolvency when Black Thursday happened. One of the major reasons was one of their auctioned off a whole bunch of ETH at $1, and then obviously you wouldn't be able to pay back the debt with $1, and then essentially they've created tens of millions of bad debt. And bad debt means those DAI cannot be paid off, and there's no way you can kind of pay it back. And that was the reason why they have to mint MKR and then in a way to pay for those insolvent debt. So we've learned from that, and we also experienced something similar, right? Because the market condition is generic. It will hit any similar protocols in a similar way. So, and we've done a number of things to, I guess, soften the blow when this dramatic liquidation happened. One thing is we've added the hybrid approach for liquidation. So there's when liquidation happened, it will actually liquidate small amount on the DEXs, and if that doesn't work means the price continued to fall, and then you couldn't actually get a good slippage. So there's a threshold set for the slippage, and then it will actually go on to auction. Right? Auction are usually slower, but probably in terms of price more efficient. So it will then actually auction the collaterals on the auction. And I think Maker also adopted the same strategy later, have a hybrid approach for liquidation. But that's where they stopped. And then we realized that you could also have another worst case scenario is you couldn't actually sell properly on the auction either, right? So that's when, potentially you could actually sell for $1 for your collateral. And that's bad because that's bad for the folks who are having the vote. That's also bad for the protocol because for the price that you cannot repay the debt, the protocol will also be in a debt situation. So we've added another cushion to the protocol where if the collateral cannot be sold using both DEX and auction, and then tried a number of times, cannot be sold and cannot repay the AUSD debt plus the liquidation penalty, then we stop there. So we no longer, give out the collateral to whoever bid $1. So then the debt will be recorded as normal in the protocol, in the protocol ledger. And then the collateral, so whether it's KSM or LKSM or whatever it is, will be put into the CDP treasury. So you can look at it as a balance sheet, right? So on one side, you will have the debt incurred. So this is specifically balance sheet for the protocol, right? The stablecoin protocol. So on one side, you record X amount of AUSD debt that outstanding for the protocol. And then on the other side is the collaterals at the time that it cannot actually pay for all the debt. And then it will also be stored in the CDP treasury. And when the event actually happened, then you may have a bad debt situation because your collateral is at a lower value than the outstanding debt. But the idea is so that you don't continue to worsen the market, because if there's a dramatic event happen, usually there's a cliff going downhill, and then if you are at this point continue to force out the collateral, then you probably end up a $1 situation. So the idea is, you then just keep the collateral, and then at a later date, then you devise a strategy to kind of liquidate the collateral and then recoup the debt, and then so that the system can go back to equilibrium. So that was the third cushion that we added in, and that's being used in this event. So it did happen, right? And KSM, it happened for Karura. It didn't happen for Acala. Acala was like coping quite well throughout the time with sufficient liquidity to help with liquidation. But on the Karura side, the KSM was like super volatile. And then, so it did happen when there's unsuccessful liquidation of collateral, and then we did manage to put some KSM as well as LKSM collateral onto the CDP treasury on one side, and then on the other side there's about a million or so debt recorded, and then on paper, it probably balances itself, but we probably don't want it to be on paper for very long. So right now, we've submitted a plan to be reviewed by Ganglet to how to liquidate these collateral. So they are in the form of KSM and LKSM. There's no KR debt there, and then so there's no KR collateral there. So just KSM and LKSM. And then how we can maybe use on-chain both DEX and maybe an open auction so everyone can participate to kind of recoup the debt in the most, I guess, efficient but also minimum impact for the market. So right now it's being reviewed, and then once we've got the first draft, then we'll post that into the forum for discussion. This is even from Ganglet, the initial feedback was they were very pleased that we had this mechanism, and it was also industry first to create such a soft cushion to protect liquidation. And they're very interested in doing more, I guess, research and analysis on it, and help us to come up with a plan to execute all of this on chain. So that was really cool because usually, when in a bull market or in a perfect market condition, everything is going to go well, right? You can look at every protocol and see, well, everyone is doing really well. But this is the time, like when the extreme condition happened, and the edge cases pop up. This is the time to kind of really see how the protocol, how resilient the protocol is, and also see areas that you can continue to improve. So. I think this is a perfect storm. We're not like very huge right now. We're only at the very beginning of our journey. So we just launched on Acala a couple of weeks, and then Karura is still like very very small, mostly waiting for other parachain to be bootstrapped so they can integrate with us and then kind of like drive utility. So we are very early. So but we are able to have this market condition. So it's kind of to our blessing that this happened, and then kind of test out all the stuff that we built in for risk management actually being used in an expected and effective way. And also kind of like push us to continue to find new ways. One is to increase efficiency of liquidity, and then another is to watch out for more risk exposures and see how we can actually continue to minimize those, right? So so this risk cushioning is kind of like really cool addition to our protocol. And then coming up though, liquidity is certainly an area that we will be focusing on. So I see the schedule that Josh put up. Later, we'll talk about the 3 pool. So that is a stablecoin pool that will help with AUSD liquidity, and then hopefully that will also help a bit on the liquidation side of things as well. And then also the AUSD now on Acala side is on exchange on KuCoin. We'll continue work on those because it is very helpful in terms of arbitraging and also help with liquidity, supply and liquidity when liquidation happen, right? Especially in a downturn. And then another thing that will be coming up is the bridge between Acala and Karura. You may not think that's a big deal, but it is a big deal because when we have the bridge, AUSD will be fungible across the 2 sides. And then what that actually means in real terms is you are going to get DOT and ACA values floating from one side to the other side, from the Polkadot side to Kusama side, and then vice versa. And that will be very interesting and very helpful for a number of reasons. Number one, when those liquidity are linked together, then certainly when liquidation, like worst case scenario happen, then liquidity can very easily flow from one side to the other side to support each other's liquidity. And usually when you have more trading venues, more liquidity across different parts, it's usually healthier market. So there will be liquidation bots, arbitrage bots, folks just trading in different places to help with the protocol to reach equilibrium. So that's number one. And then number two is essentially join the 2 economy, Kusama and Polkadot. Right now they are kind of in the parallel universe, right? You can sit on Polkadot, but look at all the stuff happening on Kusama. You can't do anything about it. But with this bridge, then usually there's more activities and faster happening on Kusama. You can now bring those values from Polkadot and then participate in some of those activities. Essentially, there's a swing of liquidity that can happen moving from Polkadot to Kusama and then participate using AUSD as a gateway, right? Because you can essentially mint AUSD from, say, DOT or LDOT and then send that across to Karura, and then it's fungible, right? So you can use in any of the pools on Karura side as well as on any parachains on Kusama that supports AUSD, and then participate in any of those protocols, and then vice versa, right? Because once the protocols launch on Kusama, Polkadot may be slower, but usually there's like more heavyweight protocols, and also the Polkadot is like much bigger in terms of liquidity. And then you can swim back those capital or liquidity onto the Polkadot side and then come back and support those protocols there. So I think, and no one has done this before, right? So essentially AUSD is not only trustlessly unwrapped, there's no wrapping decentralized stablecoin across Polkadot, but it's essentially across Polkadot and Kusama. And also in Polkadot 2.0, there will be Polkadot will be able to connect multiple relay chain ecosystem, right? So it means Polkadot, Kusama, and potentially there's a 3rd, 4th, 5th type of Polkadot chain that can be linked together. So you can think about Polkadot as a spider web, and then Kusama as a spider web, and then in Polkadot 2.0 that you can actually create as many spider web as you want, and they can all link together, right? So this is where the real scalability of Polkadot is gonna go, right? And then AUSD then is able to traverse across all of those networks in the spider web, and then support the whole ecosystem. So this is really unique what Polkadot creates, and this is also quite unique for AUSD and the protocols that we create here at Acala. And then of course with anything that's really new, you got to be quite prudent to actually look for what are the assumptions, and also what are the risk exposures. So not only just look at the upside, right? In a bull market, everything looks rosy, but it is actually really look closely in the downfall, what happens then, and how you can actually bounce back in terms of resilience. So that is sort of the short review. Well, kind of a long review of what happened, but I think it's very important people understand how we deal with this stuff, and then Yeah, and then our plans going forward. So yeah,
Yeah, thanks, Betty.
Josh, back to you. Yeah.
I'll just touch on a few of the highlights because Betty covered a lot of ground there. So when it comes to some of the market volatility we've seen, our systems have held up well, and the enhancements we've made on the maker model, including like quality of service for oracles, handling the resolving the off-chain worker issue, and then this hybrid mechanism for auctions and the debt or liquidations via the DEX and auctions, and then also this additional cushion where the CDP treasury can absorb some positions. All of those things have been really helpful for us and have made the protocol resilient. So, we were able to test those things and they functioned as expected. So from that side, things are going really well. And then, yes, some of these upcoming things like the wormhole bridge and different connectivity that will enable between Acala and Karura, and then also other ecosystems is also really exciting. Betty, one thing I did want to touch on was some of the incentive programs we have on Karura, and just remind people how we think about incentive programs and like the purpose of incentive programs and how we make decisions on certain incentive programs.
Yeah, sure. I think that's also a very important thing I want to share. I think for incentive, maybe a couple of contexts before we go into details is literally, one is we don't want to, but there's literally coded in our protocol is at Acala, we have no way to print our way to bootstrap or success. For two things. One is ACA and KR, they are non-inflationary. There's no way we can print more of those. There's no way we can increase the number of the ACA and KR in the market and try to do anything to create liquidity. There's no way we can do those. That's number one. And then number two, inherently using a over-collateralization model for AUSD, it basically says there's no free lunch. I think different protocol would have their compromises or trade-off or optimize for certain area that they want to go for. But the model we chose, mostly thinking about we are the infrastructure for Polkadot. So if you're infrastructure, that means it's very likely many others will be built upon you. And if that's the case, then it would be better to build something on a solid ground rather than sand. And that's also one of the major reasons why, after reviewing all the mechanisms, we chose over-collateralization model, and then also added quite a number of additional risk mechanism that are possible that we can do on substrate to improve risk management. So those two things add together has a lot of constraints, of course, because this is all about trade-offs, right? So we have no printing ability, and also there's no free lunch to provide those liquidity. So those are the, I think those are good constraints, but that's only because we chose how to actually create a protocol like that. And with those in mind, then we can then talk about where the incentives come from, and also how we think about using them to bootstrap, and what are the limitations, right? For Acala and also Karura, those incentives, I mean, the ones that you can see in the LP pools. There used to be, KR, ACA, and then recently it's got switched to AUSD for a little while, and then also right after the event. I'll tell you why. We also immediately also switched back and probably also reduced from AUSD back to AC and KR, and also reduce some of the incentives that are handing out. There's a number of reasons for why we need to act so quickly. So first of all, those incentives are currently come out of the foundation's private funds, right? So you can probably think about that like marketing budget. in the longer term, they could come from on-chain treasury when the treasury actually start to accrue some of the earnings and profits from various protocol. And all the protocols are still very small in size. So while there are some fees, well, for DEX, there's certainly no fees because all the fees goes to LPs. But for stablecoin, there's some fees. Our interest rate is quite low, so you're not getting a lot. But with the growth and then increasing size of the protocol, then gradually you will have those earnings be put into the treasury, and then that can be used for various different purposes, including incentives going forward. But right now, the on-chain treasury is very tiny, and also we don't print, right? If you look at maybe almost all layer ones, there's very few, in addition to Bitcoin, very few layer ones, they don't inflate, right? Most people inflate, and then they put the inflation into treasury. Well, they put the inflation partly for you to stake and earn the staking yield, and then partly into the treasury. So even if you stake 100% of the time, you are still not keeping up with inflation, yeah? Because like, let's say, protocols will give, have 10% inflation. They will usually say, like maybe a portion of those, let's say 8% of those goes back to the stakers, and then 2% will be in the treasury. So yeah, if you stake 100% of the time, you're still diluting, 2% a year over the time. Well, I'm not saying this good or bad. There's a reason for it, right? So for proof of stake, that's something that you kind of have to do, like Polkadot, you have to do to continue to support the validator sets. And then for us, from day one, we were thinking, how can we do things in a way that, that's a bit more conservative, and then also be prudent in terms of like not printing money if we don't need to, right? So in that case, then the treasury will not have any inflated token. If you hold on to it, it's the same effect as staking, and also getting that additional 2% that's in the treasury essentially. And then so that's essentially how the current on-chain treasury is. But I think over time, as the protocol, well, this is also good feedback loop, right? If the protocol is not doing well, then you have less free money to throw around. If the protocol is doing well, then then collectively we can all share those earnings on the protocol. So yeah, so we're still early stage in terms of kind of building up the on-chain treasury. So right now it's mostly just coming from the private reserve that we have, and then using them as well. You can think about them in a way like marketing budget to help bootstrap. And also because of those reasons I mentioned, ACA and KR, from our perspective, is very scarce, and we try to use them very wisely. And so that's why when we could, we try to deliver AUSD, and then keeping ACA and KR so that we don't need to sell ACA and KR off, because every one token that we give them out or airdrop them out, it's not going to come back, and there's also a limited number of those. So from a foundation kind of like continuity perspective, if possible, then we try to give out AUSD, and also AUSD is relatively stable, so it has a lesser impact on the market as well. But this is, as I said, this is no free lunch. It's not cheap to do that with the limited resources we have. So in a normal situation, we can go on for a while using this approach. But when in 2 weeks ago, when the market have the cliff fall, and then also judging on kind of like slightly more macro conditions, this may go on for a little while. And also, we don't know when is the bottom. Because if you look at history, I think ETH at some point fell 95%, right? So that means it fell as much as this time. So this time they fell maybe 50% or something. And you have to fall again another 40% to get to 90%. And then you have to fall again maybe 50% to get to 95%. So it's like the fall can be very dramatic, right? So so right now, it's only fell like 50%. You have to fall another 50% lots to get to the 95% fall. Historically, they've been there, right? And then if this has happened, and it could be worse, right? So then you have to think about, in worst case scenario, can you sustain? And then also, how can you do everything you can to kind of like to protect whatever you have, and also reduce the risk that you're taking, right? So then a number of things that we look at. One is how to be prudent to reduce debt, right? So essentially, when we are giving out AUSD, we are taking out debt ourselves. So one is like how to reduce the debt in the ways that we can. And then secondly is also be less aggressive so that we don't take out too much further debt with the limited resources we currently have. And of course, it would be a different story if we could print, but we can't. And this is actually a good thing because it forces us as a team to think very rationally. And with the limited resources, it also forces you to kind of try to make the right decision in every step, right? It's very dangerous when you have unlimited well of resource and printing ability, and there's no constraints around you. You can see how individuals and companies behave when there's no limitation, right? Whether that's legally or monetary wise or some other aspects, it's basically testing humanity, and it's very dangerous to do. So I think actually building a protocol like this and going through a market condition like this, while it felt very constrained, right? Because we do want to give out free money. Everybody's happy about free money dripping from the sky. You do no work, but you're getting all the free money. That makes everybody happy. But at the same time, I think we also feel a bit blessed, even though with all the constraints we have, we feel a bit blessed that is because of these constraints, like we self-inflicted all these constraints in protocol. It required us to, I guess, make responsible decisions, and also not go overboard with all of those resources we have. So so immediately after the sharp drop and observing the market, we kind of decided to remove AUSD as continuous as incentive for most of the pools out there, and then also swap AUSD incentive into KR and ACA, so that we don't take on further too much debt ourselves. And then, personally, I also personally participate in those pools, and it's certainly understandable that it's not a good feeling when the incentive of free money is reducing, and it's not cool when the interest rate goes up, right? Same thing happened in the fiat world, but you can also see. Well, I can certainly empathize that, but also at the same time, you can also see the market is correcting itself, right? When before this event happened, we're essentially in a quite a hyper, inflating market, even in crypto, because most of those rewards and APYs are printed. If you don't know about that, then I think you should really take a closer look and ask the hard question: where does the APY comes from, right? And I was told at one point that even 20% or more on stablecoin swaps is low APY. You're not going to attract anybody, and that was really troubling, right? And then I was also told 100% APY on other type of pools is also nowhere competitive. And that was really troubling because if I understand you can print your way through it, but if you really ask the hard question, where do they really come from? How sustainable that is? I guess during those market conditions, no one wants to think about those. But eventually, this is a time where the rates, the yields, the APIs are finding its real equilibrium, right? You can actually see where those rates are at if you look around, right? And some projects probably no longer be able to provide anything. Some projects still keeping the printing engine on in a market like this. So and And for the question of like where the yields are come from, so they're real yields coming from interest rate, right? Generated from money markets that based on supply demand. And there's staking yield coming from real proof of stake protocols like Polkadot. There's also fees being generated like the AMM pools and some other protocols that legitimately charging some fees for using the protocol. So the reality is these type of yield generation and interest rate are not going to go into high double digit or 100% plus, right? Because ultimately the interest rates, let's say interest rates from money market, they will be in line with something that's off chain.
So, like, we'll continue to provide our announcement updates, and then see you in the next community call.
Yeah, thanks everyone.